The Senate recently passed their version of the One Big Beautiful Bill Act. Let's take a dive into it and see what it is and how it compares to the House version that was passed previously. My name is Mike Balache, and I'm with Pink Harbor CPA. We serve clients all across the world, virtually or in our office locally here in Williamstown, New Jersey. So if you need tax preparation, accounting, advisory service, or tax resolution, we're the firm for you. Now, let's take a look and see what's going on. First, let's look at the income tax rates. Income tax rates will go down about 2 to 3%. So we're going to see a reduction in income tax rates. And this applies from 2026 permanently. The top tax rate will stay at 37%. So no reduction there, but on average, we're going to see income tax rates drop between 2 and 3%. Again, this will be permanent and it will begin on January 1, 2026. Next, the standard deduction. We're going to see from 2026 forward, the standard deduction, the increased standard deduction, will be a permanent deduction. This was set to expire on December 31, 2025. The standard deduction will be $16,000 if you were single, $32,000 if you were married, and it will increase based upon inflationary measures. The child tax credit. Now, the child tax credit is currently $2,000 per child for children who are 16 years of age and younger. The child tax credit, again, currently $2,000. The House wanted a $2,500 child tax credit, but only for 3 years. The Senate said, no, we're going to make it $2,200 and make it permanent. They do not want to revisit child tax credit again 3 years from now. It's going to go to $2,200 and become a permanent deduction. I'm sorry, a permanent credit under the Senate bill. The SALT deduction. Now, the SALT deduction stands for the state and local income tax deduction. So these are taxes that you pay into your state if you have a state income tax, your locality if you have local taxes, right? And your property taxes for your municipality that might collect property taxes. Now, we were under the Tax Cuts and Jobs Act, we were limited to a $10,000 SALT deduction. This hurt many people who live in high tax states. Many people live in states that had high property taxes because you were used to taking the itemized deduction on your tax return. And now with being limited to $10,000 for the SALT deduction, you are now taking the standard deduction. So it was hurting you. Now, the SALT deduction will go up to $40,000. And the SALT deduction will go up to $40,000 for people who make less than $500,000. And this will go into effect January 1, 2025. That's a key date because that means the SALT deduction is retroactive to 7 months ago to January 1, 2025, right? So last year, you took the standard deduction. Now we could be looking at itemizing our deductions. Here's another way this is going to impact you. Look at charitable contributions. Many people didn't keep track of charities they donated to or may have given less to charities because the SALT deduction being limited down to $10,000 made it not beneficial for them to donate to charity. So they limited their charitable contributions, both by cash and by non-cash. So now with the SALT deduction increasing, we could also correspondingly see an increase in what charities get as cash and non-cash contributions. And in the past, many people who did still continue to make charitable contributions stopped keeping track because it just didn't matter anymore. Now, you want to break out your calculators and your pens and your paper and your abacuses and everything else, and you want to calculate out and write down everything that you've given to charity just thus far and keep a good track for the future. With respect to non-cash charitable contributions, you want to keep an itemized list of everything that you're donating. I don't mean 4 bags of clothes. I mean 7 pairs of pants, 3 pairs of sneakers, whatever you give at a sofa bed, what the fair market value of it is on the date that you make the donation, how much you paid for it, approximately the age of it, and give that to your tax practitioner, hopefully a certified public accountant, when you're getting your taxes done, right? Because those deductions, charitable contributions, are going to come back on your return again, thanks to the increased soft deduction. Next, President Trump campaigned heavily on no taxes on Social Security. Let's see if that was delivered upon. Well, unfortunately, that was not delivered upon, but what we do have in its place is an extra deduction for people who are 65 or older of $6,000 per person. So if we have two people on the return that are both above 65, this will be an extra $12,000 deduction. This could be a substantial savings on a tax return. Unfortunately, it is phased out if you're single and the income is above $75,000 or married and the income is above $150,000. This this senior deduction is only going to be around for 4 years. Now, it'll go retroactive back to January 1, 2025. It will expire on December 31, 2028. So we're going to see it here for 25 through 28. Again, it's $6,000 per person. It is stackable, so it could be $12,000 on a married filing joint return. Next, no taxes on tips. President Trump campaigned very, very heavily. No taxes on tips. How was it delivered here in the Senate version? Well, the Senate version gave a partial delivery of it. They're saying that they're going to let you deduct up to $25,000 of your tip income. Income that's related directly to tips will be up to $25,000 as a deduction. However, this does phase out if you're single and your income exceeds $150,000, or if you're married and your income exceeds $300,000, this will phase out down to zero eventually. This is a 4-year limitation here, so this is going to go into effect January 1, 2025, and expire December 31, 2028. Key provision in here is the tips must be voluntary and customary. So first, let's talk about what customary means. There's a lot of people out there watching right now in YouTube land or Facebook land, or ever seeing this, and you're saying, hey, what if I just start paying my employees in tips? I'll give them a little bit of a wage and I'll pay the rest on tips. Well, doesn't work if it's not customary. Customary means if you're a dentist office, you're a legal office, you can't pay your legal assistant, you can't pay the dental assistant in tips. It's not customary. So that would not fly. The IRS and the people who wrote this bill are not stupid. They understand that many people would try to switch to a tippable income. Voluntary. Voluntary means that the person who's giving the tip has to have the option to not give the tip. So it does not mean that all wait staff will achieve this, that they will not have to pay taxes on tips up to $25,000. Here's why. You ever go out to eat and you're a large party and there is a mandatory tip now on your bill because you were a party of 8 or more and they add on a 20% tip? Or you ever get something catered, we have caterers come out and there's a mandatory tip, or the bill is in excess of a certain dollar amount and a mandatory tip gets added on? Well, that's not a voluntary tip. That is a mandatory tip. And that mandatory tip is 100% taxable, just as it's always been. It needs to be voluntary. Here's where I could see a problem come in. I could see a problem come in with a restaurant that has a partial voluntary and a partial mandatory tipping scheme that goes on right now, and where parties of 6 or less, there's no tip. Once you get 7 or more, you have a mandatory tip. Where does that counterbalance come in? Restaurants are not the best at keeping records the right way in their point of sale system. I could see this becoming a problem when the entire restaurant establishment is told everything you gave out now is a mandatory tip. Will we see different things happen and different things change in the catering and restaurant fields and other tipping industries? Maybe, right? But is it a definite? I think this is going to create a lot of areas to go and audit for the IRS. No taxes on overtime. Now, President Trump wanted no taxes on overtime. Let's see how this delivered. There's going to be a deduction of $12,500 of your overtime pay will not be subject to taxes. So first $12,500 if you're single, and if you're married, $25,000 will be deductible. This is going to go into effect on January 1, 2025 and expire on December 31, 2028. This applies to your overtime wages only, not your regular wages that you get or your regular salary that you get, only the overtime applicable portion. It's going to be very interesting to see how this is handled for the 2025 year. Reason being, right now, when workers who have worked overtime were paid, those workers were all subject to income tax on the overtime and the regular wage. Is the IRS going to force the employers to go back and to adjust those paycheck stubs that they've gotten and make adjustments on a W-2 to show that the wage portion that's subject to tax, which appears in box 1 of your W-2, to lower that down? Or are they going to give the burden to the individual to do that? If they give the burden to the individual to do that, I think it's going to be a little complex for an individual to do. And it's going to put a lot more individuals into using paid practitioners. If they give it to the business the same way, I could really see this overburdening the small businesses. The small little diner that doesn't really have, that has one account that comes in on a Friday, or a payroll company. They never really kept track of when everything was earned. I could see this becoming a problem. I, Either way that they make it subject to the individual and make the individual make the reconciliation of the 1040 return, or tell the employer to make the reconciliation and adjust that on W-2. Either way, by making this retroactive back to January 1, 2025, I could see it being a little bit of a nightmare. Next, the estate tax exemption. The estate tax exemption is going up to $15 million for a single person, $30 million for a married person. And this will become permanent. This was set to expire December 31, 2025. This will now be permanent. Let's take a look at how the Senate version of the Big Beautiful Bill is going to go into effect. Now, the QBI deduction. This stands for Qualified Business Income Deduction. This deduction, in a very most simplistic way that I could explain it, it really benefits businesses and pass-through entities to be able to reduce by up to 20% the income tax portion they pay. It's not self-employment tax, but the income tax portion down a 20% deduction. Okay, now the House wanted this to be 23%. The Senate said, no, we're going to keep it at 20%, but we're going to make this permanent. Now, this was set to expire December 31, 2025. It will now be 20%, and it will be permanent. Bonus depreciation. Bonus depreciation was set to reduce down to 40% on December 31, 2025. Under the Senate bill, it will be 100% for immediate expensing of qualified assets. Goes into effect January 1, 2025, and it is permanent. So no expiration at the end of 2025. Opportunity zones, permanent, no expiration. These are capital gain deferrals and eliminations in opportunity zones. These are now permanent. And last, what we call the SALT workaround. So the SALT workaround, it allows pass-through entities to deduct the state and local income taxes above $10,000. This was set under the House version. The House said, we're going to get rid of this completely. It was very, very unpopular to get rid of it. And the Senate said, no, we're going to restore it. but it's going to be, a SALT deduction above $10,000. And this will be a permanent ongoing SALT deduction for pass-through entities. So the House passed their version of the big, beautiful bill. The House then sent their version over to the Senate, and we talked about the House version and the Senate version in this video. The Senate bill then went back to the House for approval. The House could have done two things. The House could have just voted on the Senate bill and accepted it and said this will now become the law of the land, or the House could have went into what we call reconciliation, and House members and Senate members and their committees go in discussions, modify the bill, and then they agree on this modified platform. That didn't happen. And the reason why it didn't happen is President Donald J. Trump wanted to be able to sign this into law on July 4th. Why July 4th? It's a symbolic day. He wanted to be Americans' freedom of some of the taxes that have been a great burden on the American people, and he wanted to lower the tax rates by July 4th. Another reason is a lot of these provisions are retroactive back to January 1, 2025. So there needs to be a lot of time in place for things like employers to make changes of things they've already done, employees to prepare, the tax planning to go on. So the quicker we get this signed into law, the better for everyone to take full advantage of it. Ultimately, what happened, although there were some House members that said, no, we don't want to support this, um, ultimately what happened is the House GOP was able to whip the votes to be able to get this over the finish line. Now, the House voted to accept and adopt the Senate version of the bill. There was some political grandstanding, as there will always be on a minority party, where they talk and they talk. Hakeem Jeffries used his magic minute to try to just go and filibuster and talk for as long as he could. But ultimately, the House approved the Senate version of the bill. There will be a signing ceremony on July 4th for the big, beautiful bill. That will ultimately be the law of the land. So now we have a lot of tax planning and a lot of tax analysis to do, and a lot of things that are brand new. As I mentioned over and over again, many, many of you who were taking the standard deduction because you were limited by that SALT deduction, you were limited to $10,000 state and local taxes. Now you're not limited anymore, and you're going to be itemizing your tax returns again. Those of you who live in high property tax states, those of you who are higher wage earners and pay a lot of income tax to your state and local government, you're now going to be itemizing just like you did 2017 and prior. My name's Mike Mellace. I'm with Pink Harbor CPA. Any of your tax needs, from tax preparation, tax resolution, tax analysis, whatever it might be, for-profit, nonprofit accounting and advisory services, we are here to help you. Please check us out on the web at pinkharper.com or call us at 856-226-9524. Thank you.